Are your finances ready for 2020? In this on-demand webinar, OJM Group partners and team members offer advice for the new year that can help you protect personal and business assets, reduce your taxes, and build wealth in 2020 and beyond. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. We'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Hello, this is David Mandell, and I'm pleased to kick off the discussion here on what we should be doing in 2020, the beginning of the year, with asset protection, which is my area of expertise. So not a lot changes in the field of asset protection year to year. Asset protection is about protecting a client's personal and business or practice assets in a way that make it difficult for future creditors, if not impossible, to get out those assets. One area related to this is looking at the risks that would require asset protection. And certainly there's not much change in medical malpractice and your liability for employees, for slip and falls or car accidents, or all the kinds of things that our clients are concerned about and why they want to spend a little bit of time protecting their assets. One emerging risk that we've talked about and some of the other experts on our team is the liability that's emerging for businesses and practices for their qualified retirement plan, like your 401k. If the fees are too high relative to what others are paying, if the cost of the investments within the menu is too expensive, especially for the rank and file. We've seen employees sue major employers like MIT and University of Chicago successfully. I think Goldman Sachs has a claim out there. And this is trickling down into medical practices as well. So it's another place to have liability. So what to do in early 2020? If you haven't had your practice's qualified plan reviewed by a third party and get benchmarking done, meaning what the fund offerings, what the fees are, what the different roles are versus sort of best practices, you should do that because that will help reduce the risk of liability, and certainly OJM can handle that. We have for many practices. From a personal point of view, implement asset protection planning if you haven't. Okay, if you read any of our materials or watch us speak, we're not someone saying the sky is falling. On the other hand, you're in liability prone profession. Why not spend a little bit of time looking at what you can do under your state and under federal law to better protect yourself? And then if you have implemented tools, especially legal tools like LLCs or limited partnerships or corporations or trusts, make sure all the documents or entities are compliant. Make sure that someone is checking. I can't tell you how many clients come to us and they set up an LLC or a corporation or a partnership. There's never been an annual meeting and the paperwork is a mess and things have been left unsigned and it's not up to par. And if they ever rely or need to rely on that entity for protection, they're not going to get it. So just like getting checkups with your family medicine or your specialist as a patient, physicians who are doing asset protection planning should get an annual checkup on that area of planning. So be aware of the 401k risk. Do something about it by getting your plan reviewed and benchmarking it, and personally either do the planning if you haven't before, and if you have, make sure it's reviewed on an annual basis. That'll put you in a very good shape for 2020 and beyond. And some of my colleagues will take the ball and run with it and tell you about their areas of expertise.
This is Carole Foos with OJM Group, and I'm going to continue our advice for the new year with some discussions about taxes and your ability to plan for lowering your tax bill in 2020. One of the big areas that you will be able to manage in terms of taxable income will be with regard to your investment income. And throughout the year during 2020, I think you should think about a few things. The first thing on your mind might be timing of sales. Over the past several years, we've had a big bull market in the stock market, so you may be sitting on a lot of unrealized gains within your investment portfolio. Some of those might be short-term gains, given what the market did in 2019. So if you're looking at realizing some of those gains and maybe rebalancing your portfolio, think about timing. If you hold a stock for more than 12 months, you'll get long-term capital gains treatment on the sale of that stock. So that's going to be a maximum federal tax rate of 23.8% if you're in the highest tax bracket, as opposed to a short-term sale, which would be a stock that you've held less than 12 months, and that could be subject to a 37% ordinary income tax rate if you're in that highest tax bracket. If you are making some trades in your portfolio and you experience some of those gains, you might also want to think about harvesting capital losses against capital gains. What I mean by that is if you've got gains in your portfolio and you want to limit your tax exposure to those, look at your portfolio and see what positions you might have unrealized losses on. This might even occur if the market takes a dip during 2020 and you sell some assets at a loss. You can use those losses to offset your gains. Vice versa, if you've realized some losses on a sale, whether that's from stocks or from maybe an investment property, you can also sell other investments that have a gain and use those gains to offset the losses. You can then repurchase similar assets for those you sold at a gain and have a higher basis and still essentially hold the same assets. You also want to look at your investments in terms of owning the right investments in the right accounts. So if you've got a lot of investments that generate taxable income year over year, those might be investments that you'd like to have in your retirement accounts, your qualified plan accounts, where you're not paying tax on that income each year. They won't be taxed until you start to take distributions out of those retirement accounts. And then you might want to own more growth stocks in your after-tax brokerage account because those growth stocks are likely not generating dividends and therefore not generating income that is taxable to you each year. So think about those things in managing your investment portfolio and be smart with your taxable aspect of your investment portfolio during 2020. In addition to that, it's a great time to be thinking about whether you're going to itemize your deductions in 2020 or take the standard deduction. Under the new tax law that became effective in 2018, the standard deduction increased to a $12,000 deduction for single taxpayers and a $24,000 deduction for married taxpayers filing a joint tax return. When you couple that with the fact that that new tax law also reduced the ability to fully deduct state and local income and real estate taxes, those are now limited to a maximum of $10,000 deduction. It really has led a lot of taxpayers to taking the standard deduction instead of itemizing their deductions on their tax return. So because of this, one thing you might want to think about in 2020, certainly as it relates to charitable contributions, if you're making charitable contributions, but you're not quite at a point where you're still going to be able to itemize your deductions, you think you're going to be taking the standard deduction, consider bunching up those charitable contributions. So make essentially a couple of years worth of charitable contributions in 1 year versus making some in December and some the following January. You can also do this through something such as a donor advised fund, where you make the charitable contribution into a donor advised fund and then you dictate to the fund when those funds are actually sent out to your favorite charities. So even though you're making the contributions all at once, your charities are still receiving those funds over a period of time. Mortgage interest is also going to play into that factor. If you're still paying mortgage interest, that will count towards your itemized deductions in determining whether to take itemized or standard deductions. If you are now taking the standard deduction and you're not itemizing, certainly think about the cost of that mortgage interest as you're no longer getting a deduction for it. However, that being said, mortgage interest rates are still at relatively historically low rates, so it doesn't mean you should pay off your mortgage just because you're not getting a tax deduction for it. That's it for our tax advice for 2020. Look forward to hearing from some of my other colleagues with their advice going into the new year.
I'm Adam Braunscheidel, one of the wealth advisors here at OJM Group, and we wanted to just lay out a couple themes that we've seen pop up in the markets over the last 12 months and as we head into 2020. One of the big things that we're seeing has really just been the dynamic shift in the performance of value stocks versus growth stocks. As you can see here, just the difference in the performance over the last, really going back to the financial crisis in 08-09, how well growth has outperformed value stocks. So when we're talking growth stocks, it's mostly technology companies versus values, typically financials, industrials, utilities, etc. So for us, we've actually, we've certainly been helped by the large technology exposures and performance. Now that said, as we kind of look back over the past 12 months here, we've actually seen the S&P Value Index outperform growth stocks for the year now. So this has actually pushed the index it's up almost 11% over the last 3 months. And that's obviously put it on track for its strongest year since 2013. So we also look at just the price to earnings ratio, which is it's used kind of as a valuation metric, how cheap or expensive stocks are. You see financials are trading at 12.7, again, more of a value-oriented asset class, and they're right around their five-year average, while technology stocks are trading at 20.7 versus their average is about 17.7. So you could say, hey, financials are still somewhat undervalued from a historic perspective versus technology stocks are a little overpriced from a historic perspective. Now, that doesn't mean things can't continue to change or progress. Technology stocks can continue to have a nice performance and continue to get more expensive. But it's important that you at least consider these other factors as you're looking at your U.S. allocation for the year. We also wanted to just briefly touch on the dynamic change across U.S. versus international stocks. We want to make sure clients don't ignore the potential of international and emerging market stocks. So I have a couple graphics here that just kind of show you, we were curious to see what percentage of the top 50 stocks each year are non-U.S. And as you can see, this year it's been about 80. Last year was almost half. And years before that, it's, been around 90%. So as you can see, there's definitely opportunities abroad. Also, I think another changing dynamic is just how much revenue is being driven outside of those underlying markets. Let's look at a company like Nestle, for example. Although they're headquartered in Europe, only about 30% of their revenues come from that specific region. About 30% in the U.S., 31% emerging markets. So it's important to say, when you look at companies that might have be domiciled or have a footprint in a specific country or region, it's important to know where they derive those revenues from, because it typically is not exactly the same as where they're headquartered. You can just see a couple other notes or statistics that drive, emerging market performance. A lot of it's really company specific, and that's you can see just the trend there from the early 90s all the way to today. It's that much more important. And also, I think non-U.S. indexes are more heavily weighted toward lower growth sectors. So again, more of those value-oriented names, financials, energies, utilities, are much higher internationally. And kind of moving along, I think that's why there's an opportunity for a lot of these. You look at the yield on these international companies, much higher. International is about 3.4% versus U.S. is about 2%. Much higher yield opportunity across the globe as opposed to just looking at U.S. companies. You also want to consider, some of these international companies are, although they might not be as popular here in the U.S., they're pretty significantly sized. And I just kind of used a couple pharmaceutical companies to show you just the market cap of different companies and, how much bigger the opportunity set is globally. So we hope you enjoyed those thoughts, and now we will move on to the retirement and financial planning section of the video.
Hello, my name is Jason Odell. I'm one of the partners at OJM Group, and I appreciate you guys taking time to listen to our year-end planning discussion on asset protection, tax, and investments just prior to me. I'm going to talk about qualified and non-qualified retirement plans. Qualified retirement plans, there are two types. There are defined contribution plans and defined benefit plans. With defined contribution plans, you're defining the contribution. Those are most known as 401k plans or 403b plans, and there's a limited amount of money that you can defer out of your paycheck on a pre-tax basis, and that a limit is set by the government and changes year to year. In defined contributions, you put the contribution amount away, it grows tax-free, and you can access it at earliest at age 59 and a half without a penalty, and you must start taking money at 70 and a half. It is what is called a required minimum distribution. Defined benefit plans, these types of plans are a little bit different in that you're defining the benefit you're going to receive when you retire. So it's actuarially determined as to how much money you get to put away into retirement on a pre-tax basis. Therefore, these plans may have significantly larger amounts that can be contributed on a pre-tax basis and have worked well in recent years for a lot of businesses or medical practices throughout the United States where these types of plans, defined benefit plans, work well, even if you have employees. There are ways to include some employees in the defined contribution plans and then have highly compensated or the owners in the defined benefit plan as well. So you can combine these two types of plans together to make a great retirement plan for a business or medical practice. Non-qualified plans, those don't have any tax benefit on the front end per se because they're not qualified. So the IRS and the government don't set any rules that require how much money can be put in, which also means then that you can discriminate. You can have plans in non-qualified where you're putting money away for key people in your organization and not for everybody. That money can get put away and can be put away into tax-friendly vehicles where growth is tax-free and distributions can potentially be tax-free. These plans work really well if you have someone who maximizes their defined benefit or defined contribution plan, their qualified plan. If they're maximizing that, then layering in on top a non-qualified plan for those that have excess dollars to put away is a really nice feature to add. These two types of plans do not need to be inclusive or exclusive of each other, so you can do one without the other or do them in combination with each other, which makes a lot of sense. The costs for non-qualified plans tend to be a lot less than qualified plans because there's a very little amount of administration that's needing to be done because you don't have to do all the testing to conform with all the rules and regulations. So for 2020, it's advisable to take a look at what are you doing now for your retirement planning? What types of plans do you have in place? Have you had them reviewed and looked at for cost benefits as well as for whether or not you're conforming with all the new rules and regulations and you're keeping up to date with all the ERISA rules in the qualified plan. And then also, how does a non-qualified plan maybe impact your ability to attract and retain key people to your organization? Remember to also take a look at the limits that you're allowed to do in terms of how much money can get put into each of these plans for 2019 as well as for 2020 moving forward. Next up will be Michael Lewellen, who will discuss complete and comprehensive financial planning for 2020.
Well, thank you to my peers for their planning advice in the different disciplines. My name is Michael Lewellen. I'm the Director of Financial Planning at OJM. And to wrap this up, we're going to take a look at financial planning for the new year, just a checklist, some things to consider as we start out to the new year. First and foremost, you want to update your retirement contributions to your 401k, your 403b plans. They've gone up from $19,000 to $19,500. Also, if you're over the age of 50, that limit has gone up as well too. So your catch-up has increased from $6,000 to $6,500. So if you are over 50, you're able to defer $25,000 of employee deferrals. It's also a good time to review your beneficiaries on all investment accounts and any insurance policies. If anything's changed, added to your family, situations change, you've done any estate planning, it's just a good time to really take a review of all of those as well, too, just to make sure that they're allocated the way that you would like. Also, building a budget. There's no better time than the first of the year to establish it. Many clients come to us, and one of the first things that we tell them to do is say, well, let's look at the expenses from a cash flow standpoint. That is the basis of building a good financial plan. You also want to make sure that you have an emergency fund. So if you don't have one in place now, maybe one of the things from a budgeting standpoint you do right out of the gate is you save some additional cash. So you generally want to have 3 to 6 months of expenses put away. As we mentioned previously in looking at your beneficiaries, if you need to, you may find that updating your estate plan is something that needs to happen. So that may be something as basic as just getting your basic wills, power of attorneys, revocable trusts put in place, or if you're a little further along and you need to do some advanced planning, now would be a good time to start that project so you're able to get it done the first half of the year. Review your current insurance coverages. And that's something that, that can be done on the life insurance level, disability insurance, but also you want to make sure that you're reviewing everything, your limits from your auto, your home, and your umbrella coverage as well too. The auto, home, and umbrella play a large role in asset protection for clients as well too. Review your credit score. If you're on the younger side, you just may want to make sure that you're doing the things that will help build your credit. If you are a little bit older, you just may want to review your credit score to make sure that nothing is on there that shouldn't be on there. So that's something that you want to make sure that you're reviewing. Assess your debt. So make sure that you're approaching your debt in a way that is efficient as possible. So it may mean paying off some of those higher interest credit cards that you carried over from Christmas, and then spreading out some of that better debt and just addressing it in the proper order. And finally, set goals for 2020. I think that's something that a lot of clients tend to look at year-to-year planning, but really now is a good time to just say, okay, here's some things that I want to do for this year, for 2020, but also 5-year, 10-year, 20 years down the road. Set those goals, and what do you need to be doing to get there? And that's something that we do with a lot of our clients. We look at current needing from a planning standpoint and then future planning as well too. Put all of those things in place, you'll certainly be starting 2020 off on the right foot.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.